Welcome back to Startup Essentials, brought to you by Carta. In this episode, we're going to talk about one of those things that feels kind of unexciting and logistical on the surface, but when you dig down is actually super important to the successful, sustainable growth of your company. That thing is 409A valuations. And if you're watching this video, odds are you've either had to get one done in the past or you're going to have to get one done soon because your startup is preparing to raise money or give equity to employees, etc. Congratulations, by the way. To a lot of founders, very rightfully so, 409A valuations are not the most thrilling stuff in the world. Here at Carta, we get a lot of questions from founders like, wait, is that the same thing as a company valuation or a post-money valuation? When am I technically supposed to get one? What even is a 409A valuation, man? Help me out here. So in this episode of Startup Essentials, we're going to run through all that stuff. What a 409A valuation is, when and why you need one, common methodologies for doing them, and more. But before we get started, if you find this kind of startup education content useful and you want to see more of it, do feel free to assign a valuation to the like button. Hit subscribe, tap the little bell for notifications. It's helpful for us here at Carta to understand what kind of content's useful to you so that we can continue making more of it. And with that out of the way, let's get into it. This is everything you need to know about 409A valuations. Okay, so to kick things off, let's start with the official definition. A 409A valuation is an independent appraisal of the fair market value of a private company's common stock on the date of issuance, which, if you're anything like me, sounds like a whole bunch of fancy business gibberish that doesn't actually mean anything. So what does it actually mean in real life? Well, in order to understand that, let's back out for a second and set the scene. You're building a business and you've reached the point where you're hiring some service providers, maybe an employee, an advisor or two, etc. And in exchange for their services, you're going to give them some equity or shares of your company. Now, remember, there are a bunch of different types of shares that you can give people: preferred stock, common stock, stock options, etc. So to keep it super simple, for these people you're hiring right now, let's put a stake in the ground. Just say they're employees and you're preparing to give them common stock options. So in this moment, the big question for you is, when you grant these stock options to your employees, how are you determining the share price that you're going to attach to that equity? Because it's not like you can just reach up and pluck a number out of the sky and be like, this is how much my shares are worth. You got to go through a more official channel so that you can legally say, hey, I'm not making this up. This is the actual independently verified value of my common stock on the day that I'm granting it to this other person. And that's what a 409A valuation is. It's the result of you bringing in a reputable, independent third party to look at your business, compare it to other similar businesses, industry averages, etc., and factor in all the little things that make your company unique in order to define the price, aka the fair market value of one share of your company's common stock. Long story short, in order to offer or issue equity to anybody, knowing this fair market value is critically important, unless, of course, you want to risk severe IRS penalties for both the company and the people that you give equity to. So, assuming that we don't want to play with fire like that, let's get a 409A valuation done, which now brings up a brand new and very important question, which is, when do I need to get a 409A valuation? So let's talk about that. The short answer to this question is, if you're planning to offer equity to anybody at all, it's typically best practice to get an independent 409A valuation done. But if we want to talk about specific scenarios, then it generally breaks down into 4 high-level situations. You need to get a 409A valuation before issuing your first common stock options, and after you raise any kind of venture financing, which, yes, includes those early stage financing rounds where you use like a safe agreement or a convertible note, etc. You also need to get a 409A valuation if you're approaching any kind of IPO, merger, or acquisition. And finally, you need to get your 409A valuation renewed either once every 12 months or after any kind of quote-unquote material event, which is another vaguely businessy sounding word that we're going to want to break down. So if I got to get a 409A valuation whenever there's a material event, then what the heck is a material event? Basically, a material event is, this is going to sound really basic, but it's literally just any kind of event that could be considered material to your business. And I promise that's not a cop-out. Let me explain. There are a number of events that could be considered material. Obviously, raising money is one of them, but it's not the only one. Other examples of material events might be a giant new contract that you sign with a huge client, or on the other end, a giant lost contract that represents a material change in the company's revenue. Material events may also include acquisitions, where your company is either the buyer or seller of another entity. If your company received a term sheet from someone who could potentially acquire your company, also may be considered a material event. Or let's say you form a new strategic partnership that's going to open up new markets, improve your margins, etc. Guess what? Material event. And finally, even external stuff like regulatory changes that grow or shrink your company's addressable market. Yep, material event. Standard practice is to get a 409A valuation done. And at the end of the day, if you're not sure whether or not you should get a 409A valuation, it's always best to just play it safe, reach out to a 409A valuation provider, or talk to your lawyer. Make sure you're on top of it. Okay, so I know I gotta get a 409A valuation done, but what's like the actual mechanism of protection here? AKA, how is the IRS looking at this valuation and saying, great, I consider this to be officially valid? This is where we'll introduce a new vocab phrase, safe harbor. Think of safe harbor as essentially meaning peace of mind. When a 409A valuation has safe harbor status, it means the IRS can safely presume that it's valid and correct unless somehow they can demonstrate that it is quote-unquote grossly unreasonable. What this essentially means for you is that when you get your 409A done, you want to make sure that it's handled in a specific way so that it's eligible for safe harbor status. Luckily, the IRS provides 3 safe harbor methods for doing this, each of which has a fancy-sounding name that might as well be gibberish to me, so let's see them on screen right here. And the one I want you to really look at is this first one, the independent appraisal presumption, which actually isn't all that complicated. It's just where you go to a qualified, independent, third-party appraiser and have them do the analysis that we just discussed. Far and away, this is the most common approach to achieving safe harbor status, and obviously, why would we at Carta be making this video if we weren't one of these third-party providers? So yes, shameless plug, here at Carta, we are the biggest provider of 409A valuations in the United States, and I promise that'll be only one of 2 times that I ever mention it in this video. So at this point, you might be wondering, what methodology is a 409A valuation provider using to determine this fair market value for my company's common stock? In short, the thing to know is there are 3 standard methodologies that providers use during a 409A. They are called the market approach, the income approach, and the asset approach. So let's quickly touch on each one so that you understand what they are. First up, we got the market approach. Most commonly, when your company raises a financing round, it can be pretty safely assumed that your new investors paid fair market value for their shares. Although remember, those investors typically would receive preferred stock. This means the valuation provider would look at the price these investors paid and then do a bunch of complex math to make the right adjustments and determine the fair market value for common stock. Alternatively, other market-based approaches do exactly what it sounds like. They use market-based stuff like revenue, net income, and EBITDA from other comparable public companies to make an accurate estimate of your company's equity value. Next up, we got the income approach. This one's a lot more straightforward. Basically, for businesses that have sufficient revenue and positive cash flow, the 409A valuation provider can project the company's future cash flows, obviously adjusted for risk, and determine the company's equity value that way. And finally, there's the asset approach. This one's typically used for early stage companies that haven't raised money and aren't generating revenue yet. This methodology is exactly what it sounds like. The 409A provider calculates the value of all the company's assets in order to determine a proper valuation. All right, so we know a lot about 409A valuations at this point, but you might also be looking at me like, okay, Josh, but what if I forget to get one? What happens if I don't get a 409A valuation? The answer is a little surprising because if you do mess it up and fail to qualify for 409A safe harbor, the people who could really get hit with nasty tax penalties are your employees and shareholders. And it's no joke, it's definitely scary. Stuff like all their deferred compensation from this year and all the preceding years suddenly becoming taxable immediately, and then slap an additional tax of 20% on top of that, which essentially means that there's a risk that a horrible, mind-blowing tax bill could just fall out of the sky into your shareholders' laps out of nowhere, which is obviously no good. In the end, as your company grows bigger and you approach an exit like a merger, acquisition, or an IPO, the likelihood of getting audited by the IRS also grows, which is why most companies do the work to get it right from the beginning. And that's it. All the basics you need to know about 409A valuations. Now, I promised I'd only mention it twice, so yes, here at Carta, we are the biggest provider of 409A valuations in the US, so if you do find yourself in need of one or want to learn more about 409A valuations in general, we'll drop some helpful links right downstairs in the description. And of course, if you found this info useful and want to keep seeing more startup education content like it, we do encourage you to like, subscribe, hit the little bell for notifications, and we'll see you next time on Startup Essentials by Carta.